the financial side. So I'd like now to introduce Brett Hanson of Blevins Franks. Welcome, Brett. Perhaps we could start by asking if you could give a little background about yourself and Blevins Franks.
Certainly. Good morning, everyone. So, Blevins Franks provide financial planning advice to British expatriates who are thinking about moving to Europe. We have local offices in all the countries that we work in, and we provide regulated advice and qualified advice in each of the countries that we work in. Now, those countries are Spain, France, Portugal, Cyprus, Malta, and the UK. I've been based in the Javier office of Blevins Franks for 18 years, fully qualified here. I have a daughter here, starting school. My girlfriend is here, and my parents are here.
Right. So people moving to Spain will want to understand the tax system in Spain and how it differs from the UK. Could you just give us an overview of the tax system in Spain?
Certainly. So if you become a resident of Spain, or more specifically a tax resident of Spain, then you are liable to tax on your worldwide assets in Spain. There are a few exceptions, but what that means is that any income that you've got from bank deposits or investments is liable to what's called savings income tax rates, and that starts at 19% and goes up to 23%. Pension income, rental income, that's liable to what's called occupational income tax, and that starts at 19%, but can go up to 48%. You then have capital gains tax, like you do in the UK. So if you sell an asset for, say, 200,000 euros, and you bought that previously for, say, 100,000 euros, then that 100,000 euro difference in value would be liable to capital gains tax, and that starts at 19% and goes up to 23%. You have something which isn't kind of usual for UK or British people to experience, and that's wealth tax in Spain. So this is where Spain looks at your overall assets and values those assets, and then you're taxed on those assets each year, as at the 31st of December. There are quite significant allowances, but you need to be aware of this tax because this isn't a tax on the interest or the growth. This is a tax on the value. And then finally, you have something called Spanish succession tax or Spanish inheritance tax, which is kind of along the lines of UK inheritance tax, though you need to bear in mind that there is a liability between husband and wife, whereas in the UK, that isn't the case. A lot of our work is ensuring that people that move to here, those taxes are minimal, and that they're structured so that they can pass their assets to who they want without these tax liabilities, that they can enjoy tax-efficient income, and if they sell an asset, there are structures whereby it doesn't give rise to these taxes.
Okay, thank you. So how do you actually become a tax resident in Spain? Is that similar to the UK or different here?
Yeah, so there's three kind of criteria, and if you meet any one of these three criteria, then you would be regarded as a tax resident of Spain. The first thing to bear in mind is that the tax year in Spain runs from the 1st of January to the 31st of December. And if you spend more than 183 days in that year in Spain, then you would be regarded as a tax resident of Spain. Secondly, it may be that you don't spend those number of days in Spain, but if you work in Spain or the majority of your assets are in Spain, then you would be regarded as a resident of Spain. And the third criteria is if, for example, your husband or wife is living in Spain as a resident, or you have children in school here, then they would assume automatically that you are a resident of Spain.
Right, thank you. And so what are the consequences of becoming a tax resident?
Sorry, could you repeat that again?
Yeah. What would are the consequences of becoming a tax resident?
Yeah, so if you become a tax resident of Spain, then, like I said earlier, then what happens is that you're liable to tax on your worldwide assets in Spain, and you wouldn't be, for example, liable to tax on your assets in the UK, though, like I said earlier, there are a few exceptions.
Right. And one of our attendees asks, is it possible to be tax resident in two countries? So can you be resident in Spain and the UK at the same time?
Yeah, so you could be resident in two countries, and it is possible to be tax resident in two countries as well, but only where there isn't a double taxation treaty in place. The UK and Spain does have a double taxation treaty, and that doesn't mean that you get the choice. Quite often I come across people who've been living in Spain for many years, and they say, oh, well, I pay my tax in the UK because of the double taxation treaty. The double taxation treaty doesn't give you a choice. There's a tiebreaker clause, which then looks and says, right, okay, well, look, you're resident in both countries, but now we're going to look to see where you're tax resident. And typically, you're only tax resident, therefore, in one of the countries and pay tax in only one of the countries. So, so to answer your question, if then you are resident in both the UK and Spain, you will only pay the tax in one of those countries, but you've got to go through the tiebreaker clause to decide where that tax is paid.
Okay, thank you. So when people are planning their move to Spain, are there any issues from a financial and tax perspective that they should think about before they make the move, or can they wait, given that they've got to be here for 183 days before they become tax residents?
Yeah, it's a very good question. My advice is that as soon as you're thinking of moving to Spain, you should speak to someone like ourselves that can provide advice for both the UK and Spain, and just make sure that you're speaking to someone that understands the Spanish tax system. I do come across people who have moved to Spain. They've planned things before moving to Spain using their UK advisor, but the UK advisor hasn't understood the tax situation in Spain, and therefore have structured things and put their assets in structures which actually have resulted in them paying a lot more tax than they would otherwise have needed to pay. The other thing to bear in mind is that the tax system is very different in Spain compared to the UK. So, for example, if you sell your main property, your main residence in the UK as a UK resident, there's no capital gains tax. But if you sell that as a Spanish resident, then the full gain, since you've owned that property, can be liable to capital gains tax in Spain. Ayers, which are tax-free in the UK, are liable to tax in Spain. And if you want to take your pension cash lump sum, you can take out 25% tax-free in the UK. It's liable to tax in Spain. So I would say, look, speak to someone like ourselves as soon as you know that or as soon as you're considering moving to Spain, to find out what needs to be done before you move to Spain, and then what needs to be done once you're in Spain.
Okay, thank you. We now have a number of questions from people who've sent them in before the webinar. So the first of those is somebody saying they inherited some money from their mother. And my wife and I are using this to buy a villa near Javier. And my wife does not want to sell our UK home until we're fully settled in Spain and we're happy living here. I know the UK government has played around with tax relief on the main home over the years, but I've not kept track. What do I need to be aware of?
Yeah. Okay. I mean, we get asked this question quite a lot. And in fact, when my parents moved to Spain, my mother wanted to keep their family home because she felt it was a big move. She wasn't sure whether she was going to enjoy living in Spain, and wanted to keep it like a bolt home. But I think after about 2 or 3 years, they did decide to sell. There's a lot to this. I mean, the first thing is that it's the UK which says, look, if you've got a property which you've lived in all your life, then you do not need to pay capital gains tax on that. because it's treated as your main residence. Now, what the UK do, they look at what's called qualifying years and non-qualifying years. Now, for most people, all the years are qualifying. They've bought the property, they've lived in that property, the family home for a number of years, and then they sell it and say buy another property in the UK. But if you do not live in that property for a period of time, let's say you rent that property out, that would constitute as unqualified years. So that when you go to sell that property, they look at the proportion of qualified years to unqualified years. So if you'd owned that, if there was a 100,000 gain and you got that property for 10 years, but for 5 of those years the property has been rented out, then 50% of that property would give rise to capital gains tax. So at the moment, the person that's just asked the question, if they were to sell that property now, probably no capital gains tax. But if they move to Spain and they keep that property for 4 or 5 years, then there is part of that proportion of the gain could be liable to capital gains tax in the UK. In the past, they never looked at the last 3 years, but that's now reduced to 9 months. So that's one thing. But they've also got to bear in mind that once they're living in Spain, then you're liable to tax on your worldwide assets in Spain. And so if they sell that property as a Spanish resident, the whole gain potentially is liable to capital gains tax in Spain. There are some exceptions. So if you're over 65 years of age and that's been treated as your main property for the last 3 years and you sell that property, there's no capital gains tax. And if you're under 65, it's possible to minimize that tax. So they need to think carefully about this. I mean, if it's a case that they've been coming to Spain for many years, they think they're going to stay here 99%, it may be a case of looking to sell that property now before they become residents of Spain. Or possibly what I've suggested to other people at times is if there's a big gain, they could sell the property, buy another property in the UK, and then they're starting the capital gain from zero again.
Okay, thank you. Well, the next question we've had is, my wife and I have been gradually squirreling away savings in their ISAs since their introduction in 1999, and they built up a substantial pot of investments. This is their retirement nest egg and what they plan to live on when they move to Spain next year. Does the tax treatment change when I leave the UK, or are they still tax efficient?
Okay, so the thing to bear in mind here is that ISAs are tax-free for UK residents. But once you become a resident of Spain, they will be liable to tax in Spain. So any dividends that they make, any income that they pay, if you sell some of those ISAs and they give rise to a capital gain, that will be liable to tax in Spain. When it comes to ISAs in the UK, you can't add to them once you are no longer a UK resident, but you can keep them. But because of the tax implications on that in Spain, typically what we would advise is that you would sell those as a UK resident and therefore have no tax to pay, and then put them in a structure which is tax efficient for Spain. Now, that doesn't mean that the money has to be brought into Spain, but it will be in a structure which Spain recognizes, which allows for tax-free growth and minimal amount of tax on withdrawal.
Right. Okay. Right. We now have somebody asking about wealth tax. So they've been researching on the internet, and they wondered if you could explain how it works, how much it is, and is it possible to minimise what you have to pay?
Yeah. So wealth tax I spoke about briefly a few minutes ago, but in effect, what the Spanish do is that they look at your worldwide wealth and they tax it each year. The tax rate starts at around 0.25 and can be as much as 3% plus, but you would have to have wealth of more than 10 million for that kind of tax liability. Now, you do have personal allowances. You have around 300,000 euros each on a main residence. So if you're a married couple, you've got 600,000 euros on your main property in Spain before you consider paying wealth tax. But you get a further allowance. Now, the state rules give you a further 700,000 euros each. But in this region, it's actually 600,000 each. So a married couple typically have around about allowances of 1.8 million before they pay wealth tax.
Right.
I should just add, actually, that there are structures, though, that can minimise this tax. So, you know, if you are in a position where potentially you're going to have a wealth tax liability and you are seriously looking to move to Spain, I mean, obviously speak to us, because it could be that we can then negate that wealth tax liability.
Okay, excellent, thank you. The next one says they've sold their UK home and they're about to rent a villa in Spain with a view to buying nearby. They have a number of different pension schemes, private company and government, and they've assumed that the simplest, the most efficient thing to do is to transfer them all into one SIP. Is that correct, or how would you advise?
Yeah, I wish it was that simple. The thing is with pension schemes is that different pension schemes have different rules. Those rules are changing all the time. George Osborne, some years back, altered the way that pensions, the way you could access pensions. So it's quite a complex area. In fact, we have pension specialists here, which typically looks at all your pensions, do quite a bit of analysis on what the options to those pensions. They look at your attitude to risk, your objectives, your tax, kind of where you're going to be taxed, and come up with recommendations. That could be a SIP, but the fact of the matter is that in the pensions that's just been described, you wouldn't be able to transfer all those. So, for example, a government pension, I'm assuming it's, for example, a teacher's pension or a local authority pension, you can't transfer that. That stays where it is, and actually would be liable still to tax in the UK. So that's one of the exceptions I said earlier when I said that once a resident of Spain, you're liable to tax on your worldwide assets in Spain. There's a few exceptions. That's one. So if you've got an RAF pension or prison service pension, that will remain taxable in the UK. And you wouldn't be able to transfer that pension fund. State pension, you can't transfer that into another pension, but that would be liable to tax in Spain. The other thing that I think that you've got to bear in mind here is currency. You know, your UK pensions, if UK based, are always going to pay you an income in sterling, and yet you're going to be living in Spain, where you're spending euros. We've seen over the last few years the exchange rate drop from around 1.43 in November 2015 to about 1.10 at the moment. And that's a huge drop. That's a 30% drop in spending power. So what you might want to consider with the pensions that you can transfer, but only after obtaining pension advice, is potentially an international SIP as opposed to a SIP, because a SIP will always pay you your income in sterling, whereas an international SIP, it's possible to look at euros as well, or a QROPS, a qualifying recognised overseas pension scheme. I'm not advising that they do that, but that's an option. But what they really need to do is get qualified pension advice.
Okay, thanks, Brett. The next question we have here is, I have over the last 18 months moved all of my UK pensions into a single SIP, and I intend to draw down for the fund in my retirement. I plan to move to Spain in 2021 when my UK state pension starts, but my pensions will be in sterling and my expenditure will be in euros. Is there anything I can do to eliminate the currency risk?
Yes, I mean, that's basically what I've just been talking about. You know, your SIP is always going to be in sterling, but you're going to be spending euros. There is an international SIP that you could look at in relation to investing having the underlying assets in euros, or a QROPS. The alternative, obviously, is to use a currency company. Currency index, for example, to where when the money's being transferred over, it's being paid in euros.
Right. Okay, and the next person is an expat. I'm from the UK, but I'm living and working in Oman and have been for 7 years. My aim is to retire to Spain in 3 years. I have several rental properties in the UK and a couple of pension schemes. I've also built up capital in a retirement fund provided by my employer in Oman, which I can encash when I retire. What do I need to be thinking about?
Yeah, okay, there's a few things to this. I mean, I'm not specialized or qualified to provide advice to people living in Oman. I don't know what the tax situation is there, but I would imagine that the tax is very little. What I do understand, though, is that as you've been out of the UK for 5 years, there's no tax liabilities for you in the UK. When you become a resident of Spain, it sounds like there's quite a sizable amount of wealth there, which will generate wealth tax and also potentially income tax on the rental income. The other thing is that the UK have kind of played around with the tax benefits on rental income. So it may be that what you should be looking to do is selling some of those UK properties whilst living in Oman and putting your money in a structure which would be much more tax efficient for Spain. But I certainly would be, if I was yourself, thinking about the advice or seeking advice now before you become resident in Spain, because I think there is opportunities for you to make changes now with very little tax, which you wouldn't be able to do once resident in Spain.
Right, okay, thanks. Next question. My wife and I are in the course of buying a villa in Alicante and selling our UK home. As a result, we will be left with spare capital, which along with our pensions, we will live off. Will Spain tax me on the capital when I bring it into the country, and how should I invest it in Spain?
So they won't tax you on capital. So there's no tax on simply transferring money from one country to another. But certainly I would suggest that you potentially look at a Spanish tax compliant bond for investment. Now, what that means is that the money can roll up tax free, like an ISA. Only on withdrawal do you pay tax, but on the minimal amount. As to how you invest within that structure depends on your attitude to risk, because you've got a variety of different assets that can be held within there. But that would also minimize wealth tax and Spanish inheritance tax. Certainly will also give you the option of being able to leave the assets to who you want without any complications or hassle.
All right, okay. Okay, but the next person here has been advised by their golf partner. So I am planning on buying property near Calpe and moving to Spain in the next couple of years. A long-term friend who I play golf with has told me to make sure I arrange all my finances tax efficiently, but more importantly, make sure I declare everything correctly. Otherwise, the penalties and interest can be quite nasty. Is this true?
It is. Spain, in the past, if we were talking 20, 25 years ago, people would actually say, oh, well, don't worry about declaring that, and don't worry about declaring this, and put your money in an offshore account, and things like that. But, with technology changes, and also with the financial crisis, governments throughout the world have wanted more taxes and are communicating more with each other. If you think about the kind of people that are the famous people that's been living in Spain, most of them seem to have had tax investigations in the last few years, whether it's Mourinho, Guardiola, Shakira, Messi, Ronaldo. The Spanish tax system, I would say, is now one of the toughest in Europe. And what they also did in 2013 was introduce something called the Modelo 720, the Overseas Asset Declaration, whereby you have to put down your assets or your worldwide assets on a form for them then to be able to see. That doesn't incur a tax, but if you don't fill in that form correctly, the fines and penalties of not doing it or not filling it in correctly are very high. And actually, through the computer systems and everything that we have now, they're informed of most of those assets anyway. So, you know, my advice is yes, definitely put everything down, do everything correctly, employ a gestoria, which is like a local accountant, to complete your tax returns in Spain. Obviously, you know, that your tax implications may not be particularly high, and certainly if you structure things correctly, that can be the case. You can pay, live here and pay very little tax, but what tax you should pay, and declare everything correctly.
Okay, thank you. The final one of these questions is, I have recently spoken with my UK financial advisor about my proposed move to Spain, and he said that I can retain my ISAs whilst I live there, and that the spare capital which will arise on my UK house sale should be invested into an Isle of Man offshore life assurance policy. Is this all correct, and is this the best advice?
I'm sure your UK advisor has been doing a fantastic job for you whilst you are a UK resident, but what you've got to bear in mind is that they are unlikely to be, one, qualified to provide advice in Spain, and two, are unlikely to understand the tax system in Spain. In the same way that if you said to me that you were moving to Zimbabwe, I wouldn't be able to give you tax and investment advice for your residency in Zimbabwe. So what I do recommend is that you do speak to someone who is based in Spain, who's qualified to provide you with advice in Spain. The reason I say that is, like, I come across people who have stuck with their UK advisors and have made what I would say are bad decisions. Your ISAs are tax-free as UK residents, but once you become residents of Spain, they will be liable to tax in Spain. And if you put your money in a bond in the Isle of Man, then I can tell you now that it will not be tax efficient for Spain. So, like I say, your advisor's probably been doing a great job for you in the UK, but you know, you've got to change your structure now, change your mentality, in that you're now going to be liable to tax in Spain, and you need to understand or deal with someone who understands the rules in Spain, not in the UK.
Okay, many thanks, then. Well, that's all on the financial aspects, and many thanks for your input, Brett. Brett, I was just wondering, if, before you go, I know it's not your direct expertise, but your experience should enable us to get reasonable insight. If you could just ask you a couple of questions about the Spanish healthcare system. So the first one is, as a Brit during transition, do you have access to the state healthcare system, and is it free like the UK NHS? Does it depend whether you're working or retired?
Yes. So currently, if you become a resident of Spain before the end of this year, then under the withdrawal agreement, you have lifetime long access to the health service in Spain. However, that is the case if you are at retirement age and receiving a state pension. And in that situation, you would get an S1 form, and you'll be covered under the Spanish healthcare. If you are below retirement age, then, and you're working in Spain, then you would get coverage, or you can get coverage there because you're paying Social Security into the system. Now, for people that are moving to Spain before the end of this year and are not yet at state retirement age, then they have two options. One is private medical insurance, and they can take that out and continue with that until they get to retirement age. The other option is to pay into the Spanish system, even though you're not working, which is a system called the Convenio Especial, which is around 60 euros per person when you're under 65, and around about 160 euros when you're over 65.
Right. Okay, and now if someone doesn't move to Spain until 2021, after the end of the transition period, will they be able to access the state healthcare care system in future years?
Well, after the withdrawal agreement, we're not sure what's going to happen. What we can do is look at the situation for non-EU countries now, and what happens in that situation, it depends on whether there's a bilateral agreement. Now, between some non-EU countries and Spain, there is a bilateral agreement, which means that you can have access to healthcare for, say, emergencies, but you should take out private medical insurance as well if you're going on a holiday or a short-term trip. In a situation where there is not a bilateral agreement, then you should certainly take out private medical insurance. I think the thing to bear in mind here is that post-Brexit, I mean, I understand that there are many Brits that still plan on moving to Europe, to Spain, post-Brexit, and I'm sure that Spain as a whole wants those Brits to live here. So I would hope and think that there will be some sort of agreement and coverage in the future, but really they're not focused on that at the moment. What they're focused on at the current time is getting a trade agreement, and I think what we'll have to do is see in early 2021 what the situation is then.
Okay, many thanks then, Brett, and thank you for joining us, and I'll speak again.